Complete yet another assignment that the President has mandated us in the Ministry of Finance, Budget and National Planning to undertake. Mr. President promised in his 2021 budget speech that in line with the tradition established last year with the Finance Act of 2019, the Ministry of Finance, Budget and National Planning will prepare annual finance bills to support the federal government budget. In line with this responsibility of fiscal policy reforms, the National Assembly has enacted a number of laws over time, and what we seek to do in the Finance Bill 2020 is to review some of these laws. So the assignment that we undertook in the ministry is in line with the responsibilities of the ministry under the Finance Control and Management Act of 1958, the Customs and Excise Management Act of 1958, and the FRS Establishment Act of 2007, and also some of the responsibilities that have been assigned to our ministry under the Fiscal Responsibility Act of 2007. According to these assignments of responsibilities by these various laws, the draft finance bill has been prepared to support the 2021 national budget of economic recovery and resilience. To be able to do this, I have tasked the Fiscal Policy Reform Committee to prepare a draft finance bill, which is the subject of discussion today. The committee that we set up comprises economics, fiscal policy specialists, tax experts. We also had in the committee the Senior Special Advisor to the President of Economic Matters, Dr. Adeyemi Dikpeju, as the chair, and the Senior Special Advisor to the President on Finance and Economy, Dr. Sarah Alali, as co-chair. There are also as members some of the key revenue generating agencies and also some agencies like the BPP and others that are critical in terms of the reforms that we seek to undertake. The Fiscal Policy Reform Committee held extensive consultations on this draft finance bill. We had about 4 different sessions of consultations, and we had been able to get up to 1,740 participants representing professional bodies, academics, international development partners, youth organizations, civil society organizations, organized private sector, trade and industry, manufacturing and agro-processing firms, as well as oil and gas companies, banking and other financial institutions all attended these consultations. But we also had key federal ministries, departments and agencies. We consulted also with the Federal Executive Council and the National Economic Council, which is chaired by His Excellency the Vice President, with all of the 36 state governors as members. The 3 key guiding principles of the draft bill for the 2020, for the 2020 finance bill include adopting critical counter-cyclical fiscal policy measures, and this is to enable us to respond to current economic challenges of COVID-19 as well as the decline in the crude oil prices. It is also because we have had to defer any tax increases until the domestic economy sufficiently recovers. We have also had to look at reducing compliance burden on taxpayers in line with our commitment for the to improve the ease of doing business. The second principle of the draft finance bill 2020 is to reform fiscal incentives. And this is guided by the need to reduce proliferation of fiscal incentives by carefully assessing the cost of those incentives as well as the benefits of those tax incentives. It's also driven by the need to prioritize job creation, investment, and also by the need to reduce taxation by cutting minimal tax rate of companies from 0.5% to 0.25%. That's a 50% cut on minimum tax. The third principle guiding the finance bill is closer coordination of monetary, trade, and fiscal policies. In doing this, we're seeking to, the instrument of this draft finance bill, align existing tax incentives for lending to agriculture with the recent CBN moratorium and interest rate reduction for agriculture and other real sector loans, reforms to the stamp duty levy on banking transactions, unclaimed dividends, and unclaimed bank balances reforms. You recall, distinguished Deputy Senate President, distinguished senators, and participants, that in January 2020, the President assented into law the Finance Bill of 2019. The Finance Act 2019 marked a significant milestone in our country. It was aimed at bringing the country's tax legislation at par with global best practices while also increasing revenues for government. The Act was hinged on 5 thematic areas. One is promoting fiscal equity. And what we did in that law was the removal of double taxation on companies during commencement and cessation of businesses. Also, simplification for the basis of calculating minimum tax and exempting profits that have been taxed from further taxation in the form of excess dividend tax. The Finance Act 2019 also has a provision which was designed, a number of provisions which was designed to support small businesses. So the Act actually reduced company income tax for medium-sized businesses from 30% to 20%, and for the macro and small businesses, the company income tax was completely exempted. The Act also had a provision of reduction of VAT compliance burden for these small businesses. Third thematic focus of the Finance Act 2019 is aligning domestic tax laws with global best practices. And what was done was introducing significant economic presence rules for taxation of non-resident companies in Nigeria. We also had an introduction of 30% EBITDA interest rate reduction rules in Nigerian taxation. The fourth thematic area in the Finance Act 2019 is introducing tax incentives for infrastructure and capital markets. And this included reduction of withholding tax from 5% to 2.5% for roads, bridges, buildings, and power plants, making real estate investment companies pass-through entities for tax purposes, introducing favorable tax rules for securities lending in Nigeria. The fifth thematic area for the Finance Act 2019 was increasing the revenue for government. And this was did by the increase of the VAT from 5% to 7.5%, also by introducing legislative backing for banks to charge stamp duties on electronic receipts. So we did the Finance Bill 2019. Why Finance Bill 2020? So first of all, it's an instruction by the President to do annual finance bills to support the implementation of the budget. But there are also economic imperatives and key drivers for this finance bill that we're discussing today. The finance bill for 2020 seeks to make, just like the 2019, incremental tax changes to custom duties and excise, improvements in fiscal and other laws to support annual budgets. This draft bill also seeks to implement fiscal policies in line with multi-year, medium-term frameworks as well as the fiscal strategy paper, the MTEP-FSP, as well as also support other reforms that government is working on to enhance the ease of doing business. This bill like the Finance Bill 2019, also seeks over time to result in transformative reforms to Nigerian fiscal laws. So the key drivers for the Finance Bill 2019 is to create a balance between macroeconomic strategies to attract investment, to grow the economy, to create jobs, as well as immediate fiscal strategies to accelerate domestic revenue mobilization in response to the COVID-19 pandemic and the recent domestic and global economic downturn. What the draft Finance Bill 2020 is not doing is we are not increasing any taxes, so there are no tax increases. There are also no new incentives that are being provided in the Finance Bill, but there are tax reforms that are designed to support financial stimulus and also tax measures that are provided to focus on short and medium-term results. Distinguished Senate President, distinguished members and participants in this forum, the Finance Bill 2020 is structured across 5 broad thematic areas. The first is enacting counter-cyclical measures and crisis intervention initiatives. And this includes creating a legal framework for the creation of a crisis intervention fund. So beyond the COVID-19 crisis intervention fund, to create by law a crisis intervention fund that prepares us as a country for any crisis that might arise. We also have made provisions to introduce measures to allow for the recovery of donations made towards the pandemic and other potential crises in the future. Secondly, second thematic area is tax and fiscal responsibility, amending key tax legislation to implement tax reforms, amending aspects of the Fiscal Responsibility Act of 2007, amending financial reporting and other fiscal rules for companies operating in the free trade zone. The third and important thematic area is providing fiscal relief for mass transit. What we've done is to make provisions for providing fiscal support for mass transit by reviewing the duties regime for the transportation sector, targeting motor vehicles, buses, and trucks. And the purpose why this is done is to reduce the cost of transportation, which is a major input, a major push for increased inflation, including the increase in the high cost of food. The fourth thematic area is procurement reforms. We're seeking to amend the Public Procurement Act to implement a number of key procurement reforms. And the fifth thematic area is improving the ease of doing business by institutionalizing the ease of doing business reforms for prosperity and introducing provision of the tax laws that will ease tax compliance in Nigeria. We have a document that we hope the public can have access to, and it will be on the websites of the ministry and also the agencies of the ministry. And it's just an extract of what is in the Finance Bill. So I want to speak to some of the reforms that are provided in this bill. As presented earlier by the chairman and also the Deputy Senate President, there are a number of laws that have been amended. And I'll go through some of them and just speak a few of these reforms. So first of all, the Capital Gains Act, the Tax Act on Personal Injury. The proposal that we're making is to clarify that only compensation for loss of office up to 10 million naira will be tax exempt. So beyond 10 million naira, the person that is so affected will still be subjected to tax. We are also clarifying that the employers will be responsible for the deduction and accounting for applicable taxes. It was not so clear in the previous laws. The reason why this is being done is it was important to clarify who is responsible for collecting and remitting the taxes, and also where the employee receives payment for exit of employment in excess of 10 million, whether the entire sum is taxable or just the portion that is in excess. So that's why we are making this provision. The personal income tax, Section 6 of the personal income tax on business and trade, only partially carried out or due to be carried out in Nigeria. Why we are doing this, we propose this, the proposal is to introduce significant economic presence provisions in the Personal Income Tax Act. The introduction of the special economic presence rules under PITA will align the provisions of PITA on the taxation of non-residents with whose provisions as contained in CETA was provided for in the 2019 finance bill. Also, in the personal income tax, there are some provisions that were made on new trades, on cessation, on a number of interpretations, as well as specific interpretations relating to the third schedule on income exempted. And the proposal is to align the provisions of CETA and PITA in relation to commencement and cessation rules of businesses and individuals, to reinstate the word board to mean the Joint Tax Board, and correct the inadvertent error in the Finance Act 2019 that was referring to the board as the Federal Inland Revenue Service. To also exempt persons that earn minimum wage from paying personal income tax. So last year, we put, the country had put in place, actually from 2019, the new minimum wage of 30,000. As we speak, that new minimum wage is taxable. So the beneficiaries of the minimum wage pay taxes. What this exemption is doing, what this provision is doing, is to exempt people, Nigerians that earn minimum wage, from paying personal income tax. Let me move on to the Companies and Excise Tariff Act, Consolidated Act, Section 21. The purpose of the provision we have made is to delete the exemption from excise duties on non-imported goods, on goods that are imported, but the equivalent that are manufactured locally. In the Finance Act 2019, exempted imported goods of any type that are not produced from excise duties, which created ambiguities in application for the provision. As certain luxury items, such as alcoholic beverages, would inadvertently fall under the purview of excise duty. So this is just to amend that provision that was made in the 2019 finance bill. Also, on gas utilization, under the Company Income Tax Act, we make provision to clarify the companies companies that are operating in the downstream sector that qualify for gas utilization incentive under CETA, and also provisions to prevent double dipping by way of incentive that is claimed in respect of the same qualifying capital expenditure incurred under CETA and Petroleum Profit Tax Act. We also made some provisions to refine the value-added tax. And what we've done is to expand the definition of basic food items to include animal feeds, because that was not covered in the 2019 schedule of exemptions, in the 2019 Finance Act schedule of exemptions. Also, in respect of the company income tax, the charge of tax, provisions was made to streamline the application of incentives to banks that provide financing for primary agricultural production. This amendment seeks to streamline the interest exempt from company income tax to interest earned from companies engaging in primary agricultural production. The Industrial Development Income Tax Relief Act, ITRAC, there are in that section 46 a list of pioneer industries. So what we are proposing is to clarify the categories of agricultural businesses that are covered under the Pioneer Incentive. The Finance Bill 2020 is looking at the possibility of clarifying the categorization of agricultural businesses that qualify for Pioneer Incentive, essentially businesses engaged in primary agricultural production. The company income tax also has made provisions for companies that are engaged in shipping. And the proposal we have here is to clarify that non-freight income will be taxed separate from freight income. And why this is being made is that CETA has made a provision that separates a framework for taxation of companies involved in international shipping or airline transport. Present provisions inadvertently created an avenue for companies to significantly minimize their tax payable where income from other streams are commingled with those that are strictly for shipping or freight. The company income tax second schedule also has some provisions that we're seeking to amend by introducing software as a qualifying capital expenditure. This will allow, in our view, accommodation of the changing business realities of this time, because it has become now mandatory that the tax laws are amended to allow for recovery of capital expenditure made by way of investment in software acquisition and the development costs in the form of capital allowance. The company income tax also has a provision on profit exempted. To clarify the provisions that are already in the Act, what we're doing is to make provisions for pass-through status of real estate investment companies. In the 2019 Finance Act, the law had introduced a tax framework that grants RICO's pass-through status that make real estate investment through RICO more viable. The Finance Act Bill 2020 will look to augment certain provisions of CETA to clarify the tax-neutral status of RICO. On the Tertiary Education Tax Establishment Act, Section 1 of the Act, the imposition of education tax. The proposal we're making is to exempt small businesses from tertiary education tax. The Finance Act 2019 introduced companies' income tax exemption for small businesses. However, in line with the federal government objective of incentivizing small businesses, there is a need to introduce a similar exemption of the tertiary education tax. The proposal, therefore, is for the Finance Bill 2020 to introduce an amendment to the Tertiary Education Tax Act to exempt small businesses from tertiary education tax. The Company Income Tax Section 17 has a provision for authorized unit trust. And the proposal we're making is to minimize the incidence of double taxation on individual investors in collective investment schemes. The company income tax also has provision for minimum tax. This is Section 33 of the Company Income Tax. And also the Federal Inland Revenue Service Establishment Act has provisions for minimum tax. So the proposal we're making is to reduce the minimum tax rate from 0.5% to 0.25% of gross turnover for financial years ending from 1st of January 2020 to 31st of January 2021. So that is just for 12 months, for 1 year. January 2021 to 31st of December 2021. So that's just for 12 months. And also to introduce legislation to empower the service, the FIRS, to deploy technology for general tax administration, to also allow the FIRS to introduce penalties for breach by tax officials of taxpayer confidentiality. So in line with the economic realities, the proposal we're making for this reduction of the minimum tax for the period is only for 1 year, and the design is to incentivize and enable businesses to grow, even when they are not taxable because they are not making any profit. they are still subjected to paying a minimum tax. So we are reducing the burden of that, proposing to reduce the burden of that minimum tax. The bill also makes provisions that allow tax authorities to deploy ICT for the collection of taxpayer information, ease administration, and reduce the cost of collection. But in the light of this, we want to ensure that the tax authority also takes some responsibility in terms of confidentiality of taxpayer information. Let me move on to the Company Income Tax Act Section 105. And this is in respect of Stamp Duties Act Section 89. So the Company Income Tax Section 105, we have a proposal to modify the definition of gross turnover, and the revised definition will seek to clarify any ambiguity in the categories of income that qualify as turnover for minimum tax purposes. On the Stamp Duties Act, what we are seeking to introduce is to expunge stamp duties on electronic transactions and create a separate framework for taxation of electronic receipts. As part of the gradual evolution of the stamp duties framework, it is recommended that the charge levied on electronic receipts through the commercial banks is separated from the Stamp Duties Act and reintroduced as a separate electronic money transfer levy under the supervision of the Central Bank of Nigeria. It is important to note that the electronic money transfer levy is not intended to be a new levy. And also for me to use the opportunity to say, once this levy is collected, it is pooled at the Federation account and it is shared by the three tiers of government. On the VAT Act, Section 4, on the rate of tax, we have made a proposal to clarify the effective date of 1st of February 2020 for the increase of the VAT rate of 7.5%. This amendment is intended to encode into the law the effective date for commencement of the increased rate of 7.5% as directed by the Minister of Finance, Budget and National Planning. Also, relating to the VAT Act, Section 2 has a provision for taxable goods and services, and we are proposing to introduce time of supply rules. Time of supply rules will help resolve the long-standing dispute on when a transaction is deemed to have occurred for bad purposes and the rate of output and input taxes that will be applicable. The proposed change legislates the time of supply for various transaction types, including government contracts. The Company Income Tax Section 25 provision on deductibility of donations. To provide, the provision we have made is to provide a framework for recovery of donations made towards COVID-19 pandemic for future exigencies or any other such future exigencies that may occur in the future. The proposed amendment is intended to grant a tax relief to companies that donated to the government COVID-19 relief fund. Such relief is expected to serve as an acknowledgement of positive taxpayer behavior and encourage such behavior in the case of future exigencies of such nature. The Company Income Tax Section 53 on self-assessment tax payable. The provision that we are making here is to commence charging of penalties from date of filing in the case of deliberate and dishonest misstatement of tax information. Why this became necessary is to amend the provision that right now enables people to provide wrong information and are not being held responsible. The Nigerian Export Processing Zone Authority, NEPZA, and the Oil and Gas Export Free Zone has a provision in Section 8 and 18 which we are also proposing to amend. The proposal is to provide a 75% minimum export threshold as a condition for enjoying tax incentives within that zone. The NECTA Act, by exempting approved enterprises from tax filing requirements, creates the opportunity for arbitrage, where approved enterprises sell within the customs territory at no tax cost, thereby creating unfair competition for legitimate businesses operating within the tax territory. The proposal here is to change this and also, in the same time, seek to incentivize export and de-incentivize this correct arbitrage opportunity. Under the Fiscal Responsibility Act, Section 12 of the Fiscal Responsibility Act has made some provision on aggregate expenditure ceiling. So the proposal we are making is to align Section 12 of the Fiscal Responsibility Act with Section 59 and 306 of the Constitution of the Federal Republic of Nigeria, 1999 as amended. To align Section 12 of the Fiscal Responsibility Act with relevant provisions of the Constitution in terms of designated situations where, due to the occurrence of imminent occurrence of conditions that will lead to declaration of state of emergency, such as a pandemic, that the federal government of Nigeria is constrained to exceed the deficit to GDP threshold described in Section 21 of the Fiscal Responsibility Act. The Public Procurement Act is also we have a proposal to modify the Public Procurement Act, and the proposal is to modify Section 3, some key sections of the Act for the implementation of key public sector procurement reforms. The justification for this is the modification of key sections of the Public Procurement Act for the implementation of key public sector procurement. So I just went through a few key provisions of the Act. I think there's a total of about 72 amendments that is proposing to amend several fiscal laws, and I just selected a few. But the reforms that we're looking at come 2021, the significant ones would be for me to the reforms to the Customs and Excise Tariff Act, the first schedule of the Consolidated Act, the proposal to provide fiscal support to mass transit by reviewing the duties and levies regime for the transport sector, which is specifically targeting motor vehicles, buses, and trucks. This is intended to promote the use of mass transit system in Nigeria to reduce the cost of haulage of goods, and particularly in response to labor unions' demand regarding the recent increases in prices. Second major review is to revamp the Stamp Duties Act. The proposal that we have made in the 2020 draft finance bill is the provision of the Stamp Duties Act to amend it to bring it to current realities, hence the need to redraft the provision to conform with the present act. Distinguished senators, participants, thank you very much for your time.
Thank you so much, Honorable Minister of Finance, for that beautiful and detailed presentation on